Welcome to Podkey Slopcast, where AI hype meets incentives, balance sheets, and actual constraints. A lot of this week's AI story boils down to one question. Are we seeing real industrial build-out or very polished financing narratives wrapped around it? Probably some of both, and the interesting part is figuring out where the solid ground ends and the sales deck begins. OpenAI reportedly filed a confidential S1, but the key fact is what they did not say. They did not commit to an IPO date, and their own framing treats the filing as optionality, not a starting gun. That matters because the loudest commentary immediately turned it into a race with Anthropic. The stronger evidence points the other way. Both companies are downplaying urgency, and even the more realistic chatter only floated something like September as an earliest window, not a plan. So the filing can be read less as imminent listing and more as strategic positioning. It gives OpenAI flexibility with investors, regulators, partners, and employees without forcing a near-term move. The three-phase roadmap is worth reading with that in mind, on its face ending with advanced AI that's abundant, affordable, and widely distributed is a public mission story. Critics see the same language as a pre-IPO narrative because investors like growth stories and regulators like public benefit framing. Those readings are not mutually exclusive. A company can believe the mission and still package it in the language most useful for capital markets. The more concrete signal is product strategy. OpenAI is reportedly turning ChatGPT into something closer to a super app with coding tools, agents, and partner apps bundled together. That's a pretty direct monetization move. Analysts pointing to a goal of roughly half of revenue coming from business customers by year-end are basically saying the consumer chatbot phase isn't enough. Free users are audience, enterprise users are margin. The trade-off is focus. A super app can deepen retention and create upgrade paths, but it can also become bloated. If too many things are jammed into one interface, it risks weakening the simple product people already understand. SpaceX is pushing maybe the boldest compute story on the board. Musk showed a prototype satellite, supposedly delivering about 150 kilowatts of AI compute, roughly comparable to a single NVIDIA H100, with thermal management built around sun-edge orientation and radiative panels derived from Starlink. The confirmed piece is that a prototype concept exists, and the company has an engineering story for cooling. The unresolved piece is whether that thermal story scales. Skeptics are not nitpicking here. Heat dissipation in space is a real gating constraint. Then there are the capacity claims, 1 gigawatt of satellite compute by the end of 2027, and eventually terawatt scale. Musk has acknowledged those numbers are speculative and depend on launch cost and thermal solutions, which is important because the implied logistics are extreme. If the target really implies something like 7,000 launches per year, that is not just a technology question. It's manufacturing cadence, regulatory tolerance, orbital traffic, insurance, customer demand, and whether anyone actually wants large portions of AI inference or training moved off Earth at those economics. The reported Google deal is where the story shifts from concept to financial narrative. Access to at least 110,000 NVIDIA GPUs, allegedly worth $920 million per month over 3 years with early termination clauses, would instantly make SpaceX look less like a moonshot and more like a cloud supplier. But the early termination detail matters a lot. Headlines love the top-line number. Risk analysis cares about what is actually locked in, if performance, pricing, or strategy changes. The same caution applies to claims that the arrangement could add around $100 billion of value. That's a scenario, not a fact. It assumes execution, sustained demand, and investors treating this as durable infrastructure revenue rather than a one-cycle arbitrage. The IPO reports fit that pattern too. Roughly 2 times oversubscribed, about $150 billion of orders for $75 billion in shares, with a large retail allocation and a 30-day hold, all suggest intense demand. They do not by themselves prove the satellite compute thesis is real. They prove investors are willing to finance the option that it might be. One reason all these compute stories keep multiplying is simple. TSMC capacity is tight enough that competitors are suddenly becoming credible again. Google placing a 3 million unit TPU order for 2028, and Nvidia reportedly testing Intel fabs for its next-generation Feynman chip are meaningful because they signal that Intel is back in the conversation for serious AI manufacturing. Intel stock jumping about 11% tells you what investors heard. They heard that even if Intel is not suddenly dominant, scarcity at TSMC creates room for a second supplier with enough scale to matter. That does not erase Intel's history of AI chip stumbles. It means the market is repricing the value of optional capacity. In a shortage, competence can be enough. Greatness is not required. Nvidia's multi-year deal with SK Hynix fits the same logic from a different angle. High bandwidth memory has been a choke point, so locking in supply and co-designing future chips, including for physical AI and Vera Rubin systems, is less glamorous than model demos, but probably more decisive. Jensen Huang emphasizing face-to-face relationship building may sound anecdotal, but in constrained supply chains it is strategic. When everybody wants the same scarce components, commercial terms are only part of the negotiation. Trust, priority, and who gets called first matter. Goldman Sachs and JP Morgan exploring commodity-style futures tied to GPU rental prices is one of the more consequential under-the-radar developments. On one level, it's straightforward. If cloud compute is becoming a core industrial input, buyers and operators want to hedge, the same way airlines hedge fuel or manufacturers hedge metals. The upside is real. Large AI buyers could stabilize budgets, operators could manage overbuild risk, and investors would get a cleaner market signal about expected compute scarcity. The second-order effect is that once you can trade exposure to compute prices directly, AI infrastructure becomes easier to financialize. That can improve capital allocation, but it can also amplify speculation and make physical build decisions more sensitive to paper markets. So this looks useful, but it also marks a shift. AI is moving from software story to utility story, and then from utility story to tradable asset class. The governance debate is getting sharper because policymakers increasingly seem to believe AI is too economically and strategically important to leave entirely to private firms. There are reports that the US government has considered taking equity stakes in major AI labs, and OpenAI reportedly discussed donating equity to seed some form of public wealth fund. Parallel ideas like taxing equity into a sovereign-style fund are in the same family. The attractive case is easy to understand. If AI creates huge, concentrated upside, maybe the public should share in it rather than only absorbing disruption and risk. The stronger objections are about incentives. If government becomes financially tied to a few dominant labs that can blur regulator and stakeholder roles, create too big to fail pressure, and encourage a corporate-state alignment people are right to scrutinize. Some warnings go further into nationalization or authoritarian comparisons. That's where it's worth slowing down. Those outcomes are not established by the current proposals, but the concern about concentrated control over information infrastructure is not imaginary either. Meanwhile, the legislative activity is not hypothetical. Blackburn has pushed to pair AI preemption with child safety provisions, and Democrats, including Schiff, are pursuing guardrails such as human-in-the-loop requirements for military AI. The common thread is that both parties see a governance window now and do not want to miss it. The workplace data may be the best antidote to generic AI boosterism. KPMG's analysis of 1.4 million interactions says the biggest gains come from people who use AI as a reasoning partner, not people chasing cute prompt tricks. That lines up with a broader pattern in enterprise adoption. Access alone does not produce value. Most companies using AI still are not seeing much business impact, with only about 12% reporting real value and a lot of usage stuck at meeting summaries or other low-stakes tasks. So when platforms push coaching, workflow integration, ROI tracking, and closed-loop agents, that is not just vendor upsell. It is a response to the fact that shallow usage does not move the business. The gap between casual and power users also matters. Heavy ChatGPT and coding agent users reportedly generate 3 to 11 times more usage than free or light users because agents create self-improving loops that consume far more tokens. Economically, that is great for vendors. Socially, it raises a distribution question. If advanced workflows compound skill and speed for a minority, then democratizing access is not just about fairness, it's about preventing a widening productivity divide. The same shift shows up on the web. AI agents are becoming primary visitors, and many sites are structurally unprepared for them. If agents cannot retrieve, trust, or cite your information, you become less visible even if your human-facing website looks polished. And for developers, the frontier is moving from single prompts to systems that call agents in loops. People see huge efficiency gains there, but also a steep learning curve, which suggests the next bottleneck is not model quality alone, it's education, interfaces, and operational discipline. The through line this week is that AI is getting harder to separate into neat categories like product, infrastructure, finance, or policy. Each one is shaping the others in real time. Thanks for listening to Podkey Slopcast. This episode was generated by Podkey. Create your own at podkey.fm.